Kia ora everyone, welcome back to our next edition of Econ Talks. Gareth, we've had the third quarter, the September 2021 quarter GDP result coming in, giving us the first real comprehensive read on how New Zealand's economy has gone through that sort of first hard hit from the Delta outbreak. GDP down 3.7, second largest drop on record, but still in a sense glimmers of hope and some actually better results than we thought perhaps.
Yeah, the market was picking a 4.5% drop, and I think over the last couple of weeks those numbers had been improving as analysts saw some of the partial indicators coming in, but well better than the Reserve Bank's 7% fall that they were predicting, and indeed the Treasury's numbers as well, the 6.2% drop. So yeah, quite a good result, and I think what we saw coming through in the numbers was firstly, I guess, the general resilience of the economy. We're better able to adapt to working through lockdowns and the restrictions that are associated with that across most businesses, certainly a lot better than we were last year. And so the economy has largely kept on trucking as much as possible through that time. We also saw elements that, last year's lockdown, nobody knew what to expect. They thought the sky was falling in, and economists were telling them that, of course, as well. This time around, businesses' confidence has held up much better, and we've seen that show through in stuff like business investment, where last year the lack of confidence and the sort of lockdowns combined really saw a big hit in what was happening. This time, only a small drop in business investment, and most of that was actually construction related. When you look at plant and equipment and transport equipment, those areas holding up relatively well. So yeah, overall a good result in my view in terms of what it means for the economy, and it does of course raise questions too. We've come through the sort of period of level 4 quite well. Does suggest that into the December quarter, perhaps the effects of level 3 being prolonged through Northland and Auckland and Waikato might not be as much as we'd previously anticipated either.
Absolutely, and I think what you just outlined there really is that story of resilience and a stronger starting position, a stronger foundation for the economy throughout this sort of Delta period. We've been sort of seeing and hearing that from around the country in terms of not only there was a good 6-week period leading into the Delta lockdown where there was a lot of activity that could get going, the likes of the July school holidays and similar. But I think we're also sort of continuing to see that not all industries, not all parts of the economy are going quite so well. Not necessarily two-stage in terms of everyone, half are going hot and half not. But there is definitely that feeling that the distributional impacts, depending on where you are in the country and what sort of work you're doing, has been impacted, or you're either going better or worse than otherwise. What sort of insights do you have to share there in terms of how that hit has been felt across different parts of the economy?
Yeah, you look at most of the industries and across the economy, and they're affected to varying degrees. Some of them hardly at all, some are a little bit more, but generally speaking, the results are pretty positive. But there are still ones where the lockdown just directly affects their ability to actually operate, and even at level 3, we've seen that coming through as well. So we're talking the likes of accommodation and food services, obviously, and the hospitality industry still heavily affected there. We've also seen transport activity well down, and again, that relates to sort of tourism and travel being hit, and then parts of the manufacturing industry as well, where they weren't deemed to be essential services, and so they just weren't able to operate. So all of those areas recording sort of double-digit contractions in activity, and so I guess it speaks to the fact that we've had a lot of government assistance for the economy, a lot of fiscal support over the last couple of years now, and a lot of that has been broad brush. But I think if we're trying to avoid lockdowns going forward, but if we do see the need to a lockdown in future, I think the government needs to take a view that it needs to be much more targeted. And even look, when we're operating at red or orange through the traffic light system, it may well be that just focusing on some of those key industries is important, but then you don't want to be throwing good money after bad as well, and you have to be a little bit careful that you're not supporting businesses that, if we are grappling with COVID for another 2 or 5 years, God forbid, that you're just supporting businesses that aren't viable for an extended period of time. So there are issues that the government needs to work through, but by and large, across most of the economy, you've got reason to be optimistic and pretty happy with how things are turning out.
Sure, and I mean the other big one, right, for a lot of these industries, as you've just outlined, it's not that they sort of, they had work that they wanted to do, and or that they didn't have enough work. It was they couldn't do the work. There were those restrictions on their ability to trade, the ability on supply rather than demand. Demand sort of had to be held back because it didn't have anywhere to go. But what is that feeling sort of heading forward when it comes to spending activity, households? Of course, I think we're going to get a better read for how that's going to go through summer and into next year over the next few weeks as we see the Christmas spend come through. But from the GDP numbers, what sort of insights do we have around household consumption, and what is that sort of telling us about the possible future path for the economy?
Yeah, it's a little hard to gauge the extent of the sort of hit of lockdown and the subsequent bounce back when we compare it to last year. Part of that is a timing issue around when the lockdown exactly occurred. Last year it was the start of the quarter. This year it's more towards the end, and so difficult to be fully sure of that. But there were some sort of spending types and store types which seem to be a bit more heavily affected and haven't maybe seen the same bounce this time around. You're talking the likes of IT and technology, clothing as well. We saw strong results or strong bounce back last year, and maybe not the same sort of extent there. We couple those results with the fact that we know that consumer confidence has been a bit weaker over the last couple of months. We know households are also grappling with substantially higher fuel prices, interest rates that are on their way up, and while that may not be squeezing all household budgets yet, as those fixed mortgages roll off over the next 6 months or so, that will start to impact on discretionary spending as well. So just a bit of a cautionary note for me on household spending. Not enough to panic at this stage, but yeah, just concerns there. I think we'll have to keep monitoring those numbers over the next 3 months or so just to see how those outturns come out. Having said that, I think the overall strength and resilience within the broader economy, as shown in the numbers yesterday when they came out, does reiterate the fact that we don't need the sort of supersized fiscal support, the supersized monetary support that we've had for the economy, which were implemented through 2020. It's a little concerning to me that the government in their latest budget update, the HIEFU this week, has come out and increased spending allowances going forward from here. Yes, they've got better revenue projections and they haven't increased spending by as much as that revenue, but nevertheless, I look at sort of how the economy is performing and the massive capacity constraints, the sort of stretching that we're seeing across much of the economy, and I think, do we actually need to be putting more fuel on the fire and trying to pump demand a bit harder? Generally speaking, I don't think so. And I will be looking for interest rate rises next year. As I said, the Reserve Bank well underestimated what GDP would be like, and it's not the first time this year that they've done that. And so the strength in the economy does suggest that the need to be changes both across the monetary and fiscal policy spectrum.
Absolutely, and I think we'll have to continue to analyse where the government sort of puts their efforts and how much they're actually adding to that support for the economy and how much they might actually just be adding to pricing and pressures like you've outlined, but also that assessment of, okay, we've had a better starting point. Do we see that continue? How does the Omicron variant, which is now in New Zealand, play out? What does summer throughout this sort of traffic light system look like? A lot of questions, I think, still to be answered, but ending the year on probably the highest note possible, given the Delta lockdown, with a bit more confidence about how well we've been able to weather the storm once again. We will continue to assess all of those bits and pieces. We'll continue to provide updates, and we'll catch everyone else on one of our future editions of Econ Talks.